the taxation
Yeah, no
that's
problem. I
within
can
and how that works for an
see it.
investor?
Yeah, that's fine. Uh, Obviously, a slightly more complex one, so I advise everyone to talk to their accountants. But in terms of the taxation for an investor, depending on the entity that you choose to invest in, will obviously depend on the on your final tax rate when you go to pay your tax at the end of the financial year. But in summary, our trusts are no different to if you're buying a residential investment property. We get non-cash deductions as such for things like depreciation and bank setup fees and things like that. They then allow us to deduct that off the distributions that are paid to investors at the end of the financial year. So we send out a tax statement. It'll give you a percentage of what your are tax deferred. And what that essentially means is you don't actually pay that tax. In this circumstance, I think it's around 60% tax deferred. So if your distribution was $10,000, let's say for round figures in the financial year, you would actually only pay tax on the $4,000 that financial year because 60% of it is tax sheltered or tax deferred. And that then is then paid when the asset is sold and the cost base is reduced. But, along with a 50% capital gains discount may come along with that, depending on what entity you invest in. So in short summary, you get a depreciation deduction or a non-cash deduction for a portion of your distributions, which means that tax is not required to be paid that financial year. But I do advise people to speak to their accountants about that specifically, or happy to give people information or more information over a phone call because it is quite complex depending on the structure you invest in, whether it's a self-managed super fund or individual name or things like that. So hopefully that answers a bit of the question.